NIO is finally on the move, and NIO stock is up over 20% this week, with NIO signing another huge partnership. Now, I said last week that NIO had finally hit an inflection point, but I still did not expect a 20% rise in just 5 days. But there is plenty of reason for this, which I will speak about now. This is a must-watch video for any NIO investors. But before we get into it, if you enjoyed these updates and find any value in these videos, then can I ask you to hit the like button? It literally costs nothing, but it helps me out so much. I'm aiming to get 400 likes on this video. Help me hit that goal. Subscribe to the channel and hit the bell notification if you're new so you don't miss out on any new updates. I'm not a financial advisor. This is not financial advice, so always do your own due diligence. Now there's a lot to discuss, so let's get straight into it with the very latest news. NIO signs a new battery partnership with Lotus, whereby Geely will use NIO's battery swap technology in its high-end Lotus EVs. Now this is a huge development, and this is much bigger than most retail investors will give it credit for. Geely Group is one of the world's major automotive groups. Not only is Lotus part of the Geely family, but so is Polestar, Zeekr, Smart, and the biggest of the lot is Volvo. Geely produces millions of vehicles every year. So when it comes to the battery swap technology, this could be considered to be a first huge step towards proof of concept. Now, this announcement was made at the annual Beijing Car Show, where I said a couple of weeks ago was going to be huge for NIO, as we were expecting some big announcements from this and from the coming weeks. So as it says here, Geely is the big brother in this deal. Geely owns a host of both gas-powered and electric vehicle lines and has stakes in others, including Mercedes-Benz and, as I said already, Volvo and Polestar. And further developments between NIO and Geely have just been announced. At China Auto 24, William Li, CEO of NIO, has said that cooperation is always the best option. NIO has always been open to cooperation in charging and swapping technologies, as well as infrastructure network. As of April 25th, NIO had installed over 2,400 swap stations across China, with 790 stations sitting along expressways connecting the 13 backbone expressways and 11 city clusters into an expressway power swap network. So is NIO stock going to $10? One Wall Street analyst thinks so, and this is none other than Morgan Stanley analyst Tim Zhao, who says that the Chinese EV market is highly competitive, but that NIO has some unique offerings, stating that NIO could more than double from its current price, giving a $10 price target. Now, although the Morgan Stanley team have mentioned an increase of more than 40% in month-over-month sales as a positive, I personally feel that this is very misleading because that is an increase from a previously terrible month. But more importantly, Morgan Stanley analysts also noted that NIO has recently enhanced its battery as a service program, which could help stimulate sales. The Chinese EV market is highly competitive, and NIO promotes its battery as a service program as a differentiator. With that program, customers save money upfront on the vehicle's cost and are charged for quick battery replacements at swap stations throughout China. However, investors still need to realize that broader economic conditions will continue to impact sales. Even Morgan Stanley had reduced its price target for NIO last month to its current $10 per share estimate. Investors will likely need to be patient and wait for a broader economic boom in China. But something that I feel is more important than this is the state of NIO's current financials, which I will look at in a moment. But before that, battery swap is just one thing, but there is so much more to NIO than people give credit for. NIO is a pioneer in China's premium electric vehicle and technology market. They design, manufacture, and sell EVs whilst driving innovations in next-generation technologies, autonomous driving, and artificial intelligence. Although NIO is mainly known as an electric vehicle company, I think it is more accurate to describe the company as a technology company, similar as to how Elon Musk has repeatedly described Tesla. Tesla is a technology company that also makes EVs. And NIO is similar. And there are several arms to the NIO business model. NIO House, which has been expanding over the years, and now there is over 140. NIO Life. This is NIO's lifestyle brand, where NIO is tapping into brand loyalty to sell an entire lifestyle to customers. Then we have NIO Power and NIO Service. This includes home charging stations, the NIO Power Charger, the NIO Power Swap Stations, and the NIO Power Mobile System. And then finally we have NIO Phones and Nomi. NIO's advanced in-car AI assistant, it's a voice-activated AI digital companion for NIO owners. Now, all of this combined is used to encourage brand loyalty with the cross-selling of products. Looking at the latest NIO financial statements, we can see that they have a very strong balance sheet. The company has total assets of $15.5 billion US and total liabilities of about $12 billion. NIO have cash and equivalents totaling $5.4 billion and also have short-term investments of $2.3 billion. So that's a very liquid $7.7 billion. In terms of liabilities, NIO have total liabilities of 12.3, and the largest liability being trade and notes payable of 4.1 billion. So overall, this is a very strong balance sheet. Looking at it from a macro point of view, assets in general outweigh liabilities and current assets exceed current liabilities. So there is no near-term issues with liquidity or anything like that, and the total stockholder equity is $3.6 billion. So overall, it's a strong balance sheet. So there is still quite a gulf between the NAV or net asset value of NIO and the market cap of NIO. Considering that the market cap is more than 2 times the NAV valuation, but overall there is nothing majorly concerning about NIO's financials so far. Looking at the income statement of NIO, and this is where things start to get a little worrying. We can see here that NIO have increased revenue by about 10% year over year, with total revenue for the year of 7.8 billion. And although this is not bad, I would like to see higher revenue year over year in general in order to show that this is actually a growing company. But what is more concerning is the fact that costs are going up instead of down. Like NIO has been implementing cost-cutting measures over the past year, but looking at the income statement, it is very difficult to see this being implemented. Cost of sales has increased by nearly 20%, which has resulted in NIO's gross profit being slashed to only $429 million. But it doesn't stop there. General expenses and R&D expenses have also gone up significantly year over year, meaning that NIO's overall losses are now bigger than ever. Now, to put this into perspective, and I'm not trying to be a bear here, I'm not trying to bash NIO, and I'm not trying to be bearish on NIO stock. I'm literally just pointing out the actual figures and trying to explain what this means for the company. But guys, this is a loss of $3 billion for just 1 year. Now, a lot of you know that I am bullish on NIO, but I have said it time and time again that companies can only make losses for so long. Eventually, they need to start showing a proof of concept, or at least start showing that losses can be narrowing. So many of you have been asking me in the comments, is NIO the real deal? And if it is, then why is the stock price always dropping? Well, these losses have a large part to play in that. Now, I know that NIO is expanding and that NIO is launching 2 new sub-brands and breaking into other markets, and that does explain a lot of the increasing expenses. Look at where NIO is now compared to where NIO was 3 years ago. But what is major for NIO this year is that we will have the release of NIO's Onvo L60. This will debut in the second quarter, with the first product launching in the third quarter and mass deliveries beginning in the fourth quarter of this year, with William Li confirming that NIO's second brand will prioritize deliveries over gross margin. So I do wonder what effect this launch will have on NIO's current financial situation. On one hand, this will surely increase revenue, but on the other hand, NIO are not focusing on gross margins at a time when they really need to be focused on cutting their losses. Then again, NIO are well backed, which I have spoke about before, so maybe William Li feels that NIO has nothing to worry about financially. What do you think? Do NIO need to start focusing on improving margins, or will China bail NIO out no matter what the company does? And if you want to see an analysis of NIO with future predictions and my price target for the next few years, then drop a comment below. As soon as I get 400 likes on this video, I will do a NIO analysis with my price prediction for the next 5 years. NIO does have a lot of promise and game-changing technology, but there is also a lot to be concerned about too. This, of course, is just my opinion. It is not financial advice, so always do your own due diligence. Remember that I'm not a financial advisor, but if you enjoyed this analysis, then please like and subscribe. I hope you make a load of money on this stock. Follow me on Twitter, and I'll catch you